Good afternoon, everybody. Thank you for making the time for today's Know Your Numbers webinar. This is another in our ongoing series of complimentary education webinars that we will be regularly providing free for both clients and non-clients. Look out for others. We aim to produce and present around one a month. For those that don't know me, my name is Jim Bell. I'm the director at JBA. Usually, I'd have a moderator helping out behind the scenes with the admin and questions for this webinar, but as some of you may already know, I'm always keen to get this information out to you as soon as I can. And with my other team members doing some other urgent work for clients at the moment, I'm going to once again handle the whole thing myself. So please bear with me, especially as I have no moderator support. There's a time for questions at the end of the webinar, and if for some reason I can't get to them, please send me any you may have by email after the webinar and I'll get back to you. For those who are unfamiliar with the webinar environment, these are the Zoom settings. Let's take a closer look at the webinar controls. Select audio settings to select and test your speakers. Submit questions via the Q&A button. I'll try and answer those at the end of the webinar. And click leave meeting if you need to leave at any time. If you do need to leave, all our attendees will receive a follow-up email after the webinar, probably in the next day or two, and we'd love your feedback. And now the presenter screen, usually someone different from the moderator, but today just me with my contact details. Before we get into it in detail, could somebody just use their raise hand button to make sure so that I know that you can hear me? Terrific, thank you very much. There'd be nothing worse than droning on for an hour and finding no one was listening. Once again, thanks everyone for making time to listen to this important webinar. We appreciate that these are unprecedented times with great uncertainty and concern, especially since we recently went back up to COVID level 3 in Auckland and level 2 nationally, and have only just on Monday come back down to level 2.5 in Auckland. Many of you are by now aware that our purpose at JBA is for us to help our clients achieve their business potential so that they can live the lifestyle they want to. That includes not only offering clients an efficient compliance service, reducing taxes, getting tax returns filed on time, that sort of thing, but also offering tried and proven strategies to improve businesses, or in these uncertain times, strategies simply to keep you in business with a view to business growth when the tunnel of COVID ends. Our regular complimentary educational webinar offerings are part of those strategies. Before I start in detail, I thought I'd share a thought for the session. The budget is not just a collection of numbers, but an expression of our values and aspirations. And that was from Jack Lew. Hopefully, you've all updated your budgets and forecasts to reflect the challenges of the COVID-19 situation. These numbers express your aspirations for the business over the next 12 months. Now it's time to make sure you can understand, monitor, and measure what you've set in those budgets and forecasts. Today's webinar is about demystifying the most common reports you'll be seeing on a weekly, monthly, quarterly, and annual basis so that you're in control of your business performance. At the end of the webinar, you should have a clearer understanding of what the reports that we give you mean and what they tell you. While many of you have heard me express the importance of looking forward and planning, and one of my oft sayings, a goal without a plan is just a wish, you'll also be aware of my saying that you can't manage what you don't measure, which of course is purposely backward looking. How have we done? Over the next 60 minutes or so, we'll cover the importance of knowing your numbers, an overview of the different reports you should be producing, the difference between profit and cash, the key drivers of your business, how to protect your assets, and how to adopt best practice. We'll then outline some potential next steps for you to make so that you can truly understand your numbers. Please make sure you take plenty of notes today. Some of what we will talk about might sound like a foreign language to you, what I call accountanese. I'll try and keep the accountanese to a minimum, but as we are dealing with accounting concepts here, unlike most of my webinars, today there will be a bit more accountanese than usual. And I do apologize for it, but there's actually no other way of expressing the concepts we'll do today. If you hopefully come to other webinars, you'll see that they are driven with a lack of accountanese approach. Why you need to know your numbers. Knowing your numbers is vital as it allows you to interpret your reports and know if you're on track to achieve the goals you set in your business plan or business recovery plan, or even simply in your cash flow forecasts. Here are my top 6 reasons why you need to know your numbers. They tell the story of your business, allowing you to interpret the results of your business activity. This helps you identify the symptoms as against the root causes. For example, a decline in gross profit is a symptom of perhaps many root causes, such as ineffective pricing, too much rework, poor buying, wastage, that sort of thing. So in this particular example, a decline in gross profit may not necessarily be caused by one particular cause. Knowing your numbers will enable you to spot early warning signs of potential issues. For example, monitoring how long it takes customers to pay you allows you to quickly respond if those payment day numbers start to increase. Of course, if that were the case, you'd have a disastrous approach or worse approach on your cash flow. Number 4, areas of strength and weakness will be highlighted. For example, your balance sheet indicates whether your business value is going up or down. Understanding your numbers also means you have reliable information to base your decisions on. And finally, knowledge is power. The more you know about the business, your business, the better your business will be. We'll be reviewing each of these key reports to help you understand what you can learn from them. We'll work through an example to show how key learnings and things to look out for in your reports. We'll use the same fictitious company, Foods Co, for the examples, and all the numbers are made up. They are not representative of any particular client of our firm. Let's look at the trading account first. Your trading account tracks your sales, cost of sales, direct variable costs, and gross profit to calculate the return you're achieving before you deduct your fixed and overhead costs. Your gross profit percentage indicates whether your margins are improving or deteriorating. How much profit per $1 of sale. You can track your results across different divisions or by product lines by using multiple trading accounts. And with our Xero software, many of our clients are using tracking to differentiate various divisions within their business so they can see how their particular trading division is compared to another. For example, if you have regional locations, having a trading account for each location allows you to track how each location is performing. Small adjustments to the items in your trading account can have a huge impact on your overall results, and I'll demonstrate that now. This is an example of a food manufacturing company's trading account. As you can see, they had just over $1 million worth of sales. Cost of sales, $318,000, giving them a gross surplus from trading for just under $700,000. Their direct costs were $450,000, so their gross surplus was $248,000, giving a gross profit percentage of 24%. Let's say this company undertakes a coaching program with their accountant and implements strategies to increase their customer retention rate resulting in a 10% increase in sales. They also work with their accountant to review their inventory processes and reduce their cost of sales by, say, 5%. They renegotiate their contract with their delivery providers, resulting in 5% saving in direct costs. And as a result of all these changes, their gross profit has increased by $141,000 and their gross profit percentage from 24 to 35%. Understanding your trading account allows you to identify areas where small improvements can have a big impact on the profitability of your business. Profit and loss statement. Your profit and loss, also known as income statement or statement of financial performance, shows all your earnings and costs over the year and tracks the overall performance of your business. It matches your income and expenses for the period under review. It's important to remember that profit is not the same as cash. The profit shown in your profit and loss statement includes non-cash expenses such as depreciation. You must ensure you have sufficient profit to cover cash costs such as loan principal repayments, asset purchases, and drawings that don't appear in your profit and loss statement. Your profit and loss statement provides a framework to benchmark your results by using percentage or comparisons between years to compare your business performance either internally from year to year or as against similar businesses. Businesses are generally valued using a multiplier of earnings, so your profit and loss statement is a fundamental driver of your business. The higher your earnings, the higher the value of your business. This is an example of a profit and loss statement using the same fictitious food manufacturing company I used in the trading account example that I realized I probably went through a wee bit too quickly. For those that want to have a look at this again, the webinar video will be on our website in the next day or two, so feel free to have a look at that during the wee hours of the midnight if you can't sleep. I'm sure it'll put you to sleep. We've taken the gross surplus from the trading account and listed all the expenses followed by the owner's remuneration to calculate the net surplus or loss on this page. As you can see, the company is trading at a loss of over $113,000. Let's say the company undertakes a review of all their expenses with their accountant and identifies potential savings to be made in their insurances and rent. They contact an insurance broker and their landlord and they negotiate a 5% reduction for both of these expenses. They've saved $597 in insurance expenses and just under $3,000 in rent. However, you'll notice accountancy fees have gone up. Remember, in the previous example, the company had engaged their accountant for coaching and other services. So we're trying to be transparent here. Despite the increase in accountancy fees, the overall net surplus has increased by $138,000 to $57,000 due to the savings made both in the profit and loss and the trading account. The balance sheet, also known as a statement of financial position, provides a snapshot of your business's financial position at a specified point in time. For most businesses, at the end of the tax year, 31st March, but for many businesses, quarterly, 6-monthly, or more commonly these days, monthly, so we can see how the business is tracking. It measures the net worth of your business, which is your assets less your liabilities. It also shows if your business is solvent or not. If your liabilities are greater than your assets, then the business is insolvent and urgent action is needed to fix this. You can compare different periods to determine whether business net worth is increasing or decreasing, say between years, and you can track the strength of the business. The stronger your balance sheet, the easier it will be for your business to survive a downturn. We have seen a number of businesses struggle as a result primarily of COVID of late, but prior to the COVID pandemic happening, their balance sheets weren't particularly strong to start with. Simply put, if you have, for example, a whole lot of money in the bank and you have a strong balance sheet because of that, then you can be reasonably assured to be able to survive most downturns. If, however, that you're borrowed to the max and then have a downturn, it's when things get shaky. The balance sheet also provides a basis to calculate key ratios such as, and I touched on them before, debtor days and inventory days. These calculations are what we call analytical review calculations. As you can see, the company is currently insolvent as it has more liabilities than assets. And again, this is using the same information from Foods Co that we've been using for the last 20 minutes or so. Its working capital is also negative as its total current assets are less than its total current liabilities. This means that the company cannot pay its short-term debts from the limited cash, debtors, and stock it has on hand. Some of you today will have understood this without any problem at all, and to others it may well be new, having this sort of information pointed out to you. But clearly, in this example, the company cannot pay its short-term debts of $162,000 when it only has $138,000 in short-term assets, and indeed it still has to sell its stock and collect its debtors. Urgent action is required to remedy this. The business needs an injection of funds of at least $305,000, which may be in the form of share capital or a shareholder loan. $305,000 is the net assets, or in fact in this case, net liabilities figure. Like I say, this can be in the form of share capital or a shareholder loan. Assuming the company can resolve these urgent solvency issues, there are other areas for improvement too. Over the long term, the company could implement strategies to reduce their debtor days, the number of days it takes to collect money owed to the company, and inventory days, the number of days stock is sitting on the shelves without bringing any money in, having money tied up in stock. Decreasing both of these days will increase your cash flow. The faster you can turn your stock over, the faster you get your debtors collected, the more positive your cash flow is. To calculate your debtor days, divide debtors by the sales and multiply by 365. Debtors being 72,000. If you recall the trading account, the sales figure was just over $1 million. Divide those together and multiply by 365, you find your debtors days is 26 days. This means that on average, it takes customers 26 days to pay their bills. If you do this for your business and find that the debtors days is going up rather than down, that may well be one major pointer to the fact that you are probably feeling squeezed for cash. If the company updated their terms of trade and requested payment within 7 days and managed to reduce the debtor days by 5 days to 21 days, then they'd have an additional nearly $14,000 available. Yes, this is only timing, but it certainly would be far more beneficial to get it in than have it sitting out there. To calculate the inventory days, divide inventories by cost of sales, then multiply by 365. And again, the cost of sales figure comes from the trading account. In other words, this formula shows how long your cash is tied up in inventory. The company currently holds inventory for 74 days. If they reviewed and updated their inventory processes and reduced the amount of inventory they have on hand, in other words, aren't overstocked, they may be able to improve their inventory days by 9 days. This would result in a cash flow positive boost of just under $8,000. So while this cash flow gain of $22,000 doesn't fix the solvency issue, $22,000 being the debtor improvement and the inventory improvement, it demonstrates how much cash could be saved with the help from your accountant or your in-house people who are monitoring these sorts of things. Statement of changes in equity, another of those unusual pages that are in the financial statements that we present at year end. The statement of changes in equity shows what happens to the profits. They could be paid out as dividends or kept in the business as retained earnings. Now, these profits are after payments of shareholder salaries and bonus salaries at year end. The statement of changes in equity shows the net worth or value of the company and is a key indicator of the company's financial health. It shows whether a company is solvent. Remember, if the company has more liabilities than assets, it's insolvent, and funds will need to be paid into the company. And this is another document which will show either a negative position, which will be insolvency, or a positive position, which will be a net assets or solvent position of the company. Statement of changes in equity. The company in this example, again using the same company and same figures, has accumulated losses for at least the last 3 years. This means that the company has no retained earnings and is currently insolvent. You might recall the $305,000 figure we spoke about 5 minutes ago. There's no money to pay out as dividends and no money to reinvest into the company to purchase new assets. The directors must take action now to increase the profitability of the company. And as an aside, not only must they take action now to increase the profitability of the company, directors can be held personally liable for creditor losses should directors of a company that is insolvent allow the company to continue to trade. So the directors won't be able to hide behind what they call the corporate veil if ultimately the company goes under and creditors start chasing directors for trading while insolvency. So it is an important piece of information to know whether your company is solvent or not, above and beyond the fact that it may or may not have money to pay you out as a dividend. In the good old shareholders' current account, I'd be a rich man if I had $1 for every time I had to try and describe how this particular account works for people. The shareholder current account records all funds introduced to the business by the shareholders or taken out of the business as drawings. It can help you monitor your personal expenditure from the business, and for businesses with more than one shareholder, it maintains a balance of the amount each shareholder has introduced or withdrawn from the business. If one shareholder is pumping money in and the other one is spending it like crazy, this is where it will be seen in the financial statements. It shows how much the business owes to each shareholder. If the account is overdrawn, it means the shareholder has taken out more than they've put in, or more than they've put in and been credited by way of shareholder salary from company's profits. That year-end adjustment that we do, and we say your company's made $50,000 and we've given it to you as a shareholder's salary because of perhaps it's better for tax purposes, or you've taken out drawings that we need to repay. To put the account back into a positive balance, the shareholder can repay the loan, because when a shareholder's current account is overdrawn, that is in fact what the shareholder's current account is. It is a loan from the company to the shareholder. The shareholder has drawn out more than they were entitled to, more than they had put into the business, or more than the profits that have been credited to them. Or if it is able to, the company can increase its profit to pay its shareholder by way of salary or dividend if there are sufficient profits in the company to help reduce this overdrawn shareholder's current account. So if your shareholder's current account is overdrawn, it's important to get good advice from your accountant as soon as possible to discuss the best options for you and your business. Not only may this scenario raise solvency issues, but there's also costly tax issues as a consequence of having an overdrawn shareholder's current account. And some of you from time to time may be aware that we have touched on this when we've spoken to you during the course of our preparing your annual accounts for you. Others, great, we haven't had to have that conversation, and hope we never do. So the shareholder current account shows that in this example. At the start of the period, the company owed its sole shareholder, Mr. Doe, $29,000. He has introduced $2,000 into the company during the year, taken out $9,000 by way of general drawings and life insurance payments. And at the end of the period, the company now owes him just under $22,000. The amount owed by the company to Mr. Doe can be repaid to him if the company is solvent and has the cash available to make this payment, and it will be tax-free to Mr. Doe. Because our example company is insolvent, Mr. Doe will in fact need to introduce more funds into the company so it's not trading while insolvent, if we think back to the $305,000 insolvency position we have for Foodco. So even though he's entitled to take $22,000 out of the business, there's no money for him to do so, and in fact he needs to put more money in to avoid trading while insolvent. To ensure the company will be able to repay the funds introduced, a profit improvement strategy should be implemented so the company becomes profitable. There's no point throwing money into a company if you're never going to turn it around and make it profitable, so you can get your money back and current earnings back in the future too. For example, we demonstrated in the trading and profit and loss account examples how small changes to processes could result in an improvement of $138,000. You may recall we looked at the rent, we looked at insurances, we looked at one or two other things, and found an improvement of $138,000. It's not sustainable for shareholders to keep introducing money into a business if it's not profitable. And in fact, it's not wise to do so, because ultimately they won't get it back and they are depleting their personal wealth. And we don't want anybody to be in that position. Fixed asset register, also known as a depreciation schedule, records a business's fixed assets such as vehicles and plant and equipment, and facilitates the spread of the cost of assets over their useful life. It provides a basis for keeping track of a business's assets and can be a useful guide to determine when assets need to be replaced so they can be budgeted for accordingly. It's also useful for when selling a business, as it records the current book value of all fixed assets. A comment on that, however, is most businesses show their fixed assets at book value based on tax depreciation rates. They are arbitrary rates as decided upon by government. The true value of assets are what somebody else is willing to pay for them, which is a little bit more harder to determine. But at the time a business is looking to be sold, it's well worth having a discussion with your accountant to ensure that you get the best value in terms of your tax approach for the assets that are sold with the business. The first column of the fixed asset register lists the names of all the assets, with the second column listing the cost on their purchase date. The next column shows the opening value of the asset at the start of the financial year, the current financial year, and this is the cost less the closing accumulated depreciation from the previous year. The next two columns show any purchases or disposals of new and old assets. A disposal would simply mean that the asset has reached the end of its useful life for depreciation purposes and no longer holds any accounting value, or it may have been sold. Then we have the depreciation rate and method of depreciation. And most businesses, as we say in New Zealand, are accounted for, or most businesses' fixed assets are accounted for on arbitrary tax depreciation rates. This company uses the diminishing value method, the DV, which depreciates each asset by a constant percentage each year. Probably the most common method. The next column shows the depreciation for the period, followed by the closing accumulated depreciation. This is the amount the asset has been depreciated by since it was purchased. So we see, for example, the van at the very top. Original cost was 22,000. Closing depreciation, accumulated depreciation is 16,000. And finally, the closing value column shows the current value of the asset I just mentioned, closing value of 5,000. This is the value that will be recorded in the balance sheet, right at the bottom, the 297,316, the total of all the fixed assets. So that sums up 6 of the key reports that you should be producing regularly, not just necessarily at year end. Each report tells a different story about your business, yet they interrelate to each other, as you've seen. And each report, while telling a different story about your business, aids your decision making in a different way. If you have any questions about any of these reports, send them through and I'll try and get to answer them shortly. If I can't get to answer them today, I will send you an email with an answer over the next few days. Now let's change tack and now move on to understanding the difference between profit and cash. We've been talking mainly about profit to date, or the lack thereof when a company's insolvent, but let's try and understand now the difference between profit and cash. It's common for business owners to get frustrated that their bank account doesn't seem to reflect their profits. If I had $1 for every time a client has said to me, how can I have made so much money? I don't have any money in the bank. I'd be a rich man. It's essential that you understand the difference between profit and cash and why a high profit doesn't necessarily result in more cash in your bank account. A profitable business can go out of business because it's starved of cash. I liken the concept of cash to being like oil in your car engine. The engine won't run for long without a good supply of oil. For me, cash is king. A business running at a loss can survive if it has access to funds from its shareholders, investors, or financiers. A profitable business without cash, perhaps the cash is all tied up in stock or debtors, or has been drawn out by the shareholders, which is not uncommon in New Zealand. A profitable business without cash can go out of business very quickly, and over my career I've seen that happen far too many times. In other words, cash flow is every business's reality and every business's necessity. A business owner can focus too much on turnover without getting the cash in because a high turnover sounds good, right? Wrong. True story. I once had a meeting in my boardroom around a table with a client and his sales team. I asked them, because it was, if the company was failing, if cash was low, what would they do? To a man, they said, increase sales. hardly unexpected being the sales team. I then showed them, though, that the immediate cash going out of the business to achieve those sales, cash going out for more goods for resale being purchased, more sales reps being taken on perhaps, more cars for the reps, more cell phones for the reps, more cash going out in commissions, more salaries to the reps, without at that time having the cash coming in from the sales that they were making. They were turning the sales, of course, into debtors, which are always collected later. That scenario would have the effect of putting the company underwater faster. The look on their faces was priceless, and the poor company owner's face went white as a ghost. And that's a true story. And to me, it proves the concept that cash is king. It's not about making sales, it's about keeping the cash. Of course, you do have to make sales to get the cash, but cash is king. To demonstrate the difference between profit and cash, let's consider these items. GST. This affects your cash balance, but not your profit. So let's put it in the cash column. Loan repayments. They too affect your cash balance, but not your profit. Interest on loans. That affects your profit. That comes off your revenue figure to reduce your net profit. But it also has to be spent. It's cash, so out it goes too in the cash column as well. Asset purchases. They're only cash items. They don't affect your profit and loss, so you can see profit's still up there. We haven't got anything more depleting profit at the moment, but cash is going out. Asset sales. They don't affect profit, other than perhaps depreciation recovery, but that aside, that's a cash item. Of course, asset sales are something companies that are struggling with cash flow should look at closely doing, and any surplus assets that are unneeded at the time, should be sold to get the cash in. That helps the cash balance, of course. And let's look at depreciation, and I think you know where I'm going with this one. That affects profit, but it doesn't affect cash. So as you can see, even if your business has achieved a healthy profit, there may not be any cash in the bank after paying tax, after making loan repayments, after buying new assets. I think this clearly shows the difference between the concept of cash versus profit, and why you may make some reasonable profits but not end up with that cash in the bank. The Business 101 cycle is another useful way we use to demonstrate the difference between profit and cash. First, the owners need to invest money in the business. You've got to start with some. And unfortunately in New Zealand, most businesses, when they start, are tremendously undercapitalised. But that's what it is. But certainly that's what we see. This money can be used to generate income by initially purchasing assets that are needed to run the business. The business may need additional funding to buy all the assets they need, so they may take a loan to finance the purchases. These assets are then used to generate a profit. You can increase your profit by growing your sales or your margins, but overhead expenses can drain your profit and result in a loss if they're not managed properly. The profit then gets turned into cash. Drains on your cash include slow collection of debtors, high inventory days, loan repayments, tax repayments, and payments to suppliers. A business can achieve cash gains, though, by collecting the debtors faster, as we saw earlier, decreasing their inventory days, as again we saw earlier, and negotiating longer payment terms with their suppliers, and of course, reducing taxes legally. The owners then take cash out of the business's drawings or personal loan repayments. The remaining cash can then be reinvested into the business to purchase more assets to generate more income. The aim is to go through the cycle as quickly as possible to increase your return on investment. Now, I agree that this particular example is probably a little bit more complex than the one on the previous page, but it just goes to show how all of these concepts tie in to end up hopefully resulting in cash for the owners to take out of the business. Because after all, that's why you're in business. That's why you get out of bed in the morning and go to work. After cash flow, business value is the next most important measure of a business's success. Part of knowing your numbers is understanding and measuring the drivers of your business. These drivers might be your monthly recurring revenue, revenue growth, revenue per client, sales, or profit. These will be different for every business, but we can and do work with clients to identify the drivers of their business. The more knowledge for these particular aspects that a business owner has, the more likely he is or she is to make the right decisions to increase cash, profit, and the value of their business. To enhance the value of your business, you must first develop and implement a clear plan and document your organization structure and role within your business. Businesses don't manage themselves, and businesses don't create profits by themselves. They need to be planned. And too often we see businesses that are not planned and that seem to be, to me, like corks in a bathtub of water and just being thrown around by the market environment that they're in. And unfortunately, that's been highlighted and magnified under current times with the COVID pandemic economic situation that we find ourselves in today. Establishing cloud-based real-time reporting allows you to make early and better decisions, and reviewing and documenting your systems and processes ensures your business is running as efficiently as possible. So we're now looking at the approach to not just look at the numbers that we have looked at for the last half an hour or so today, but what we need to do to make sure that we can get our hands on those numbers. Reducing the reliance on the owners of the business helps enhance the value of the business too, as it will be easier for new owners to take over when the business is sold. So if a business doesn't have to just rely on good old Jim, then the business is worth more, because when Jim leaves, the business is still going to be driving good value to its customers. And finally, identifying and managing risks means that these risks can be mitigated before they become an issue. All businesses have risk, but the more we can reduce them, manage them, the better. And to do that, we have to identify them first. So let's now look at protecting your assets. As we've seen throughout the webinar, the profitability, cash flow, and value of the business all affect you personally. If your business isn't profitable, doesn't have much cash available, you won't be able to pay yourself to fund your desired lifestyle. And after all, from our point of view, this is why I'm in business, is to help clients fund their desired lifestyle, to get the lifestyle you want. I certainly don't get a kick out of just doing tax returns. That doesn't get me out of bed in the morning. And anyone that thinks so probably needs to have a good hard look at themselves. There are a few other things you can do to help protect your assets, which I'll quickly run through. Set up your business as a company to limit your personal liability. Remember though, if you are a company director and you are running the business while it's insolvent, then you may well find that your liability isn't hidden by the company, but you become personally liable for creditor losses yourself. That said, a business run properly and well through a company, and a business that is solvent, or a company that is solvent, then the concept of a company and limited liability is a cornerstone of business and very, very necessary. Very few of our clients are sole traders. Most we advise to trade through the limited liability company. In doing so, you need to consider who should be a director of your company and which assets are held personally by the directors and which assets are going to be held by the company. You need to ensure that you have security over any money you lend to others and that you lend to your business. Too often we see people throw their own money, their own capital at their businesses, particularly when their businesses have cash constraints, to find it gets lost. And when a company unfortunately goes into liquidation, the good old shareholder is way down the track and doesn't get their money back because secured creditors and even other trade creditors get their funds first. Consider alternative ownership structures for high value assets. For example, if your business owns the commercial premises that it trades out of, you should consider moving the ownership of the premises to a separate limited liability company than the trading company, or perhaps even to a trust. And we advise often on those sorts of structures for long-term protection. You would need to review your terms of trade and credit policies to ensure you only provide credit to customers who are likely to pay you. Bad debts, we don't want them. They happen, but let's make sure our terms of trade and credit policies are strong so that they're minimized. Review your insurances and make sure you have sufficient protection. For example, do you have business interruption insurance, indemnity insurance, and enough cover to ensure the impact on your business of any adverse events is as minimal as possible? We had a retail client in Newmarket some years ago whose shop was above a restaurant. The restaurant in the evening caught fire, burnt the shop above as well. Client couldn't trade there any longer, managed to find separate premises though, and their business interruption insurance and their other insurances were sufficient for them to be able to continue to trade and stay profitable and continue with their dream, their business. Ensure you undertake financial planning to manage your personal wealth outside of the business. It's all well and good having a successful business, but what you do with your money personally, well, private and of course up to everybody's own discretion, if you are spendthrift and let it go through your fingers, then perhaps when it comes time to retire, you won't have the retirement that you perhaps should have. If though you enjoy life as you go, because no one knows what tomorrow will bring, but put a little bit aside and undertake some degree of financial planning, some degree of personal budgeting, then your personal wealth outside of the business should be taken care of. And finally, plan for the future. Do you have an up-to-date will, powers of attorney, and a clear plan for transferring your assets to the next generation, your nearest and dearest? This isn't an exhaustive list. They're just some ways that you can protect both your business assets and your personal assets. We can help you identify specific ways you protect your assets. Every client is different. There's no one size fits all. But I thought it was important to put that in with the rest of this webinar today, because it's all right making profit, it's all right making money, but again, you're going to lose it all if something untoward happens, such as that example I just gave you of the Newmarket retail client. Fortunately for them, they were adequately insured and had structures in place to enable them to continue to trade. So how does everything I've talked about today come together as what we think is best practice? Every business should use the 3 essential tools. Number 1, an annual business plan, or in these times, a business recovery plan. Number 2, or B, an annual forecast, a cash flow at the very least, if not a budget too. Remember, cash flow forecasts the bank account and its movements. A budget includes the non-cash items like depreciation and outstanding debtors and creditors. In other words, they tie in closely to the concepts we've spoken about today about cash versus net profit. But at the very least, if you don't want to go to the extent of the detailed budget, a cash flow forecast, because cash is king, it's like the oil in your car, is the most important thing to forecast. And number 3, or C in this, what should have been A, B, and C, what we think really important, completely overlooked, ongoing reporting and accountability. The reporting ensures the numbers you want to achieve in your plan and forecast are being measured. Remember, you can't manage what you don't measure. The accountability process is some form of coaching and being held to account for the decisions and actions that need to be made to improve the business. Accountability is the glue that ties commitment to the results. Using an independent person, an independent coach, an accountant, and I stress independent, to hold you accountable works. At the beginning of my career, I thought it was just garbage. I thought it was perhaps just talk. For the last 30 years doing what I do, I'm now convinced that people need to be held independently accountable to ensure that the decisions that they think they should make or agree that should be made are actually made. My own firm, I'm accountable as well. I practice what I preach. And by the way, over the years, I've heard many husbands and wives say that they will hold each other accountable. I've sat in my boardrooms and I've said, who's going to hold you accountable for these things that you need to do and that you've agreed you need to do? They've often said each other, and it never happens. Or if it does happen, it never ends well. And that's the dynamics and politics of the marital relationship. Coming back to this concept of independent accountability. Knowing your numbers is just the beginning, but it allows you to improve them, it allows you to measure them, and ultimately achieve your goals for the business. So again, what we're trying to do at the moment is put all that we've learned today together in a package to say why this is all necessary, how this is all necessary, and what you need to do to give yourself the best chance of maximizing the returns for the hard efforts that you put into your business life. And believe you me, everybody there today is putting in hard effort. I can't imagine that anybody in business not working very hard at the moment. Your next steps. So where to from here in these challenging times? My aim is to help you take what you've learned today and implement some positive changes in your business. Now it's time for you to decide what you're going to do. Take a few minutes after the webinar, I'd suggest, to write down 3 actions or 3 projects that will add value to your business. You owe it to yourself, you owe it to your business to take, 10 minutes. Just write them down, think about them over a coffee or a beer. What problems are you experiencing in your business? Identify these problems and use them as an opportunity to create a project to fix them. Once fixed, it's no longer a problem. A business with lesser problems than it had yesterday is becoming more valuable. And chances are there'll be more cash flow, and chances are more cash falling out of it for your pocket. In our view, doing nothing right now should not be an option. So now you know what you should be doing as best practice in your business. Here's how we think we can help you. If you don't currently have a business plan or a business recovery plan, we can help you develop one. We can also create or update your current cash flow forecast, which reflects the ongoing impact of COVID-19. I've updated mine, or JBA's, 3 times since January. And perhaps in the next few months it will be required to be done again. Time will tell. But I need to know where I think the business is going. I need to know what the business and cash flow requirements will look like under various circumstances, good, bad, and steady as she goes. For those who need to be held accountable to complete your actions, we have a range of coaching options, depending on the frequency which suits you. Most commonly, we see people quarterly for these sorts of coaching support, accountability meetings, but monthly are available too. We can create your management reports each month. We use Xero cloud-based accounting, and we have numbers of clients we do management reporting for each month, and we give them a very simplistic bullet point report with their numbers, and we catch up with a free Zoom quick review meeting for no more than 10 or 15 minutes each month to review those numbers so we can discuss potential areas for improvement. And finally, we offer a complimentary one-hour review meeting for both clients and people who aren't clients, just to see where they're at and what we think they perhaps should be doing to improve their current position. Now, we know it may be difficult to commit to spending money right now, and I've said this for the last 4 or 5 months with respect to these webinars. All of these services include an assessment as to how you can improve your profitability and cash flow. So there will be a great return on investment for this process over time. The business will improve if you are managing it. It will improve if you are measuring it. It will improve if you are planning. It will improve if you are working on your business rather than just in your business. For the short term, though, we have different payment options available, so please don't let cost be a barrier. We have funding partners to spread payments over 12 months. We have numbers of ways of assisting you with paying professional fees so that that is one less problem to worry about, and you can get stuck into the meat and bones, meat and potatoes of running a business and measuring it and managing it. So for those that feel that they need to or have taken it on board, get in touch with us and we'll see what we can do to arrange a structure for you to manage. We know the benefits you'll get from these services will be far greater than our fee, but most importantly, it's about helping you as quickly as possible and ensuring we are working with you to help you build a stronger and more resilient business. While I have shown some specific examples today, made up of course, please be aware that the information in this educational webinar is general in nature and no substitute for specific tailored advice and support. By working with you guys one-on-one, we'll be able to identify the most important actions to take that will give you the biggest impact on your results. Question time. I've had a couple come through. What is the difference between the annual accounts and accounts that can be produced through the year? Well, it's a good question because they're slightly different approaches. The annual accounts contain year-end adjustments, things like depreciation, tax, splitting of interest and principal on loans, prepayments and other accountanese type things. The annual accounts are done and pick these things up to A, meet the tax laws, and B, to, or equally, or probably more importantly, to reduce the incidence of tax. The main difference though is that they are historical. They are done after the year end and sometimes quite some time after the year end. The regular management accounts are produced a number of days after month end and give you up-to-date data. They're really the reason why the cloud-based type accounting, up-to-date information, coded all the time, is necessary. So you can get your hands on not quite such tax-driven type accounts, but more management decision-making type accounts. How's the business doing? I hope that's answered that person's question. Another question, what is the difference between markup and margin? We've spoken about gross margin. Is that the same as the markup I put on my prices? Well, typical accountant, yes and no. The markup in terms of dollars is the same as the margin, and that both are different. Sorry, the markup in dollar terms is the same as the margin in that they both are the difference between the cost price and the selling price. But in terms of percentages, markup and margin are quite different. For example, if you buy, I'm just trying to jot this down as I talk through quickly. If you buy stock for $75 and sell it for $100, your markup is 33%. 100 divided by 75. The margin is 25%. 25% profit divided into the sale price of $100. I hope that's made sense to that person. Otherwise, email me and I'll give you that $100 example and send it to you so you can see the difference. So there's a yes and no to that. It's effectively the approach or the direction or the look at the difference, how the difference between the purchase and sale price is approached. Well, that's the last of the questions that I've been sent. Thanks for making the time to attend this webinar. I do appreciate your time. It's very valuable. I know there were a number of accounting concepts talked about today, so don't worry if you don't understand them all. I know some of them would have been confusing, but for those that want to go over them again, the video of the broadcast will be put onto our website in the next day or two. So if there are parts of the video that are of more of interest, perhaps the numbers side of things, by all means, go onto our website, go into the gallery and click on the video, and you'll be able to come back to whichever part of it you want. Probably tomorrow you should receive a follow-up email from us that we'd love you to provide feedback on, so we can continuously improve and get your thoughts on what other webinar topics you'd like to see from us. We can only improve our support of you if we know what you want, as well as what we think that you need. Keep a lookout for our ongoing series of these complimentary education webinars. As I said at the beginning of this webinar, we'll loosely aim to produce perhaps one a month. There are plenty of places for you to register for them, from our direct email advertising, from the footer of our emails, from our Facebook page, and from our website. I'm sure the topics will be of interest to most people. There'll be some topics which won't for some, and others which will be for others, but generally speaking, there'll be a wide, diverse range of topics, so most people should pick something up of interest over time. Please feel free to invite others who you think may benefit from our webinars. You can on-send our invitations or the links directly to them. Our webinars are for clients and non-clients alike. Look out for our next webinar. It will be coming up in the next 5 or 6 weeks. It's with respect to personal budgeting. It won't be full of accountanese like today's one was, but it will give advice on how to gain control of your personal finances, how to manage and reduce your debt levels, how to perhaps build better money habits, and more. So until then, I look forward to presenting to you again soon. As I say, the topics won't be quite as accountanese heavy as they were today. I apologise for that, but can't see another way that I could have got this information across. Until I talk to you again, have a great evening. Bye for now.